Hi everybody. As the border have reopened and we can see there's a lot of interest in all those recovery play stocks, travel and hospitality related stocks. So today I'm going to talk about the hospitality REITs listed in SGX, and is there any risk or opportunity for these REITs? This is a Business Time article which published on 1st of May, which showed that the 4 pure play hospitality REITs with Singapore assets have an average of 23.4% total return year to date, which is a very respectable return when you compare to the current global market situation. Does this 4 hospitality really worth for us to invest on it? Let's look further. These are the 5 hospitality trusts listed in Singapore, where 4 of them have Singapore assets, and one of them, ARA US Hospitality Trust, have only asset purely in US. And we will zoom in to look at all these 5 hospitality trusts. The first trust we look at is called CDL Hospitality Trust. It is one of the first hospitality trusts that's listed in SGX, where he have property in Europe and the Asia Pacific region. This is a CDL Hospitality Trust. Do take note, for all hospitality trusts, they are called a stapled trust, where they have a REITs and a business trust combined together as one entity to be listed. As the REITs will be the one that collecting the rental income by renting out the properties. The business trust is the one that do the operation of the property. However, for most of the hospitality trusts, their business trust side is dormant, where the operation of the property, they leave it to the tenant to do the operations. So CDL have property across 8 countries, and they have 90 properties that are in operation and 1 property that's currently in development. And this is where you can see all the property is in Europe and the Asia Pacific region, and plus Maldives. So let's look at the portfolio contribution to the risk. From here, you can see that the property in Singapore makes up close to 65% of the total portfolio value for these REITs. And thus, the opening of Singapore will have a more direct impact to these REITs compared to some of the REITs that have lesser Singapore property exposure. This is a financial metric where their gearing is 39.8%, which is still within a healthy range. Do take note that if they were going to acquire property further without any divestment of property, there may be certain form of fundraising in future if they were to do that. The interest cover ratio is 3.4 times, which is also on a very healthy range, where the MS requirement is 2.5 times. One of the things that you may want to take note on this is currently they have about 25.8% of their debt that is due to refinance in this year 2022, where they are still currently in discussion with the bank on the refinancing options. As we know that interest rate is rising, so they may refinance at a higher rate. That will depend on what is the negotiation outcome on that. So this is one thing that you need to take note on this, as 1/4 of their debt are due for refinance. When I look at REITs, one of the key things I will look at is their dividend trend, not their dividend yield. So I will prefer a REIT that their dividend is either stable or increasing, as this will indirectly have a positive impact to the share price. So let's look at this CDL Hospitality Trust. Their dividend history since their IPO in 2006-07 that year, their dividend is 8.98 cents, and it has started to increase for 2008. But at 2009, which is a global financial crisis, they have a drop in their dividends, which is actually acceptable as the whole world is suffering and the whole stock market have crashed during that period. But what we want to look is after the crisis, how they perform. Their dividend has actually managed to increase until FY 2012, but after that is all the way downtrend for their dividend payout. This is one of my concerns on this REIT, where their dividend are not able to maintain and have been dropping. And for FY 2020 and 2021, their dividend is half, but this is due to the COVID situation, where we know that all the hospitality trusts have suffered badly, as nobody are allowed to travel. We can't move around and hotel room is vacant. So this is expected. So what we want to see is going forward, when the market recover? Are they able to recover back their dividend to the pre-COVID level, and are they able to increase their dividend from there onwards? The second hospitality trust we want to look at is called the Far East Hospitality Trust. This is the only pure SG play hospitality trust listed in Singapore. All their properties, which is 12 of them, are all physically located in Singapore. And this is a trust structure where all their property are under master lease and their business trust is practically dormant. These REITs currently have 9 hotels and 3 service residences in Singapore. And this is where they're located in. Majority of them are in the central and town area, with 1 village residence in Hougang area and 1 hotel in Changi area. And you can see that they don't have a 5-star hotel among their properties. From this revenue contribution, majority of the revenue is contributed by the hotel, and the service residence only contribute about 13.4%, but the commercial side is only contribute 18.1%. So this is their capital management, where we can see that their gearing is in a lower range, which is 33.4%, which is pretty healthy. Why is that so? As they have divested of Central Square to clear off the debt, which is why their gearing have come down to 33.4%. And their interest cover ratio is on a healthy range of 3.7 times. Another thing, when you look at their debt maturity profile, where this year they have no loans that need to refinance as it already been done. So they got no worries about refinancing risk for this year. And one thing I will highlight about this REITs is they have started to have a change in management fees for FY 2021, which is to be aligned interest with the paper securities holder. And this REITs manager voluntarily cut their own fees by changing the fee structure. Their base fees have reduced from 0.3% to 0.28% per annum based on the value of the property. This will result in $500,000 decrease in their income, in their fees. And the performance fees, they have changed it from 4% of net property income to 4% of net property income, or 4% of annual distributed amount for the financial year, whichever is lower. And most of the time, the annual distributed amount will always be lower than the net property income. Indirectly, they are also cutting their performance fees, and their performance fee have dropped by 26.7%. So the manager have cut their fees by about 1.3 million for FY 2021. And this can be translated to be dividend payout for investor, which is a good news to the investor for these REITs. The third hospitality trust we're going to look at is called Frasers Hospitality Trust. Frasers Hospitality Trust is under the sponsor of the Frasers property. We have another 2 famous REITs called the Frasers Centrepoint and the Frasers Logistics and Commercial Trust. And this Frasers Hospitality Trust have 15 properties over 9 cities, which is mainly on Europe and the Asia Pacific region. From this table, you can see that the Singapore properties only contribute about a quarter to their net property income, where the major contributor is mainly from Australia, which comprises 37%, and UK about 17%. And thus, these REITs will have more direct impact for global reopening rather than only Singapore reopening, as their property is scattered around the Europe and the Asia Pacific region. Let's look at their capital management structure. One thing I'm not so comfortable is their gearing is 42.3%, which is, to me, is on the high side. And also their interest cover ratio is 2.4 times, which is actually not really very healthy. The MAS requirement is 2.5 times. But due to the COVID situation, MAS had actually sort of waived off this requirement temporarily to let the REITs able to survive and able to grow and recover from the COVID. We can see that the CDL and FI, their interest cover ratio already went up to 3 over times a day, but this REIT is still over at 2.4 times and with a gearing of 42.3%. Thus, if they will want to par down their gearing, they may need to divest property, or if they were to want to buy another property, most likely they need to have some form of equity fundraising for them to do so. Let's look at their dividend history. At 2005, where the REIT is IPO, they managed to pay a dividend of 7.56 cents. After that, the dividend have dropped to 5.38, and it continued to drop year on year until 2019, where the dividend have dropped about 30 to 40% from the IPO time. When it comes to the COVID situation, of course, the dividend is dropped even more, and more than 50%. So you can see that this REIT actually is very badly affected by the COVID situation compared to the first two REITs I talked about. So this is one thing you need to take note when you want to invest in this REIT, as they don't have a very good track record on their dividend paying. This is taken up from their presentation side, where they have also warned about the uncertainty of the Ukraine crisis may have a negative impact to them, where they talk about, besides the COVID situation, where they talk about the Ukraine, it may result in higher costs, it may result in their expenses go up, revenue drop, and profitability drop. This is just talk about their warning that although the market is recovered, but the Ukraine crisis may have a negative impact to them. A lot of you may have noticed that these REITs have actually grown up close to 40% this year compared with the other Singapore play REITs that is grow up only by around 11% on average. Why it is so is there is talk about this hospitality trust will be privatized, but nothing is confirmed yet, and even the risk manager also never confirmed that they are being privatized. But from the Straits Times article, you can see that they have received the board approval to explore a privatization, and they have hired a financial advisor to look at it. So this is one thing you need to take note about this REIT. There is a chance that it may be privatized. This is why their share price has went up. But what happens if it turns out to be they are not going to privatize, and there may be a negative impact to the share price? The fourth hospitality trust I'm going to talk about is a non-Singapore play hospitality trust. It is the first pure play US hospitality trust, and is currently the only pure US hospitality trust play listed in Singapore. It currently have 41 hotels over 22 states of the US. And this REIT is a pretty young REIT, which is just IPO before the COVID. Let's look at the financial situation of these REITs. Their gearing actually, to me, is considered very high. Although MAS limit is 50%, but anything 45 and above, to me, is considered very high. And they are 44.9%, which is at the brink of hitting 45% already. And their interest cover ratio is also pretty low, is 2.3 times, which is below the MS requirement of 2.5 times. So this is one thing that I'm a bit concerned about this. And this REIT is a small REIT with a market cap of less than 300 million. Thus, for them to actually grow and for them to actually bring down their gearing in the future, they may need a lot of fundraising activities. The good thing is they don't really have much debt to really need to refinance for 2022. At least this is one concern being removed. One of the concerns of this is the occupancy for districts. Maybe that's how the US market works. The occupancy for district before the COVID is only 60%. Of course, there's a drop during the COVID period. But when they project the future growth will still be 60%, which is the norm maybe for the US side. But when I compare to those REITs that have Singapore properties, the occupancy rate in normal time is usually more than 80%. When I invest in REITs, we want to have as high occupancy as possible so that you can really so-called maximize it, the space, and fully utilize it. So this is one of the concerns, if the occupancy rate is really on the low side when you compare to the other four REITs that is listed on SGX. And because of the high gearing, in February this year, the manager had even announced that they may need to divest of their property just to bring down their gearing. Because there's only two ways, either they sell property to bring down gearing, or they do an equity fundraising to ask investors for money to pay down their debt. This to me may not really look like a very healthy move. The fifth hospitality REIT I'm going to talk about is called Ascott Residence Trust. It is the biggest hospitality trust listed in SGX. We have 95 properties over 44 cities in 15 countries. And besides having property in Europe and the Asia Pacific region, they also have 11 properties in US. This REIT is a bit unique compared to the rest of the hospitality trust, where their focus is mainly on hotels plus service residence, where the hotel will be the major contributor to that. And we know that for hotel, it will usually be more volatile, as traveler will only stay for on average for 3 to 5 days, and also it will depend on season. There is peak season, there's off-peak season. So it may create certain instability in their income distribution. But for this REIT, you can see for the 90 over properties, only 18 are hotel, where the main bulk is on the service residence. Service residence, you see the stay will be longer, much longer than compared to staying in a hotel room. The next one, they got even for long-term stay, which is the rental housing and the student accommodation. And let's look at their income structure, where they got a mixture of stable and growth income source. For master lease, you see it talk about very stable, where you rent a whole property out to an operator where they'll pay you a fixed income, and this is create a form of stability income. And for management contract, you see it's tied down to the revenue generated by the properties, and this may be variable on that, especially when it comes to hotel. The variation can be big due to peak season and off-peak season. Let's look at their capital management, their financial structure. They have a very healthy gearing of 37.8% and a very healthy interest rate cover of 3.5 times. So one thing about this hospitality trust is that they give you a direction where they are going. They are going towards income stability. As if you are buying for income, for retirement income, you will want the dividend to be stable. Depending on hospitality trust for stability income, if it's mainly on hotel, then the income may not be that stable in the aspect. And thus, these REITs actually have started to transform themselves to grow on their student accommodation and rental housing, which currently contribute about 17% to their total income. Their long-term plan is to have longer stay accommodation contribute about 25 to 30% of their income. And this will provide more stability to the REITs distribution. But however, do take note that student accommodation can provide more stability, as when you go into a hostel, you may stay in a hostel for 3 years, rather than go into a hotel, you stay for 3 to 5 days. However, when the thing is become popular, more and more people going into it, and there is more and more supplies coming out for student accommodations, and this will indirectly actually press down the cap rate for the student accommodation. So this may be one of the challenges these REITs may face when they're going to acquire more and more student accommodation, where it is no longer as attractive as the initial phase where they have a by higher cap rate. And this is from their side, where they had mentioned that rental housing and student accommodation actually are unaffected by Omicron, and it actually contributes 28% of their first quarter 2022 gross profit, and it's up 12%, as they are constantly buying more and more student accommodation during this period. This will create more stability for this. Now let's look at the performance of these 5 hospitality trusts. This is a year-to-date chart for the 5 hospitality trusts. Frasers Hospitality Trust are up close to 40%. Key reason is there is a news of it going to be privatized, and thus it has shoot up. It's not because of recovery. And the other 3 hospitality trusts that have property in Singapore, you can see on average they are up about 11 to 13%, where the ARA US Hospitality Trust is flat year to date. Do take note, this is price charts excluding dividends. Let's look at the price charts before COVID until today. None of the REITs have actually recovered to the pre-COVID price, which the ARA US Hospitality Trust is still 42% down from the pre-COVID level, where the rest is around 10% down from the pre-COVID level, except for the 5 hospitality trusts, which is very close or around the pre-COVID level. And these REITs have seems to be recovered the fastest. One of the key reasons is their property are all located in Singapore, and some of their hotels are being used as a stay-home notice hotel by the government. So during the COVID period, this hotel is still in operation and still have income paid by the government. Up to now, there is still 3 hotels under the stay-home notice category, which are still being paid by the government on that aspect. And this will explain why the share price is more stable compared to the rest of the hospitality trust. So let's look at long-term perspective. What is the share price performance of these 5 hospitality trusts since their IPO until today? We have seen that CDL and Ascott have the longest history where they have been through the global financial crisis, where you can see CDL from IPO, you actually have a 55% capital gain. But you look at the price fluctuation, is the highest. The price swing will be the highest compared with the rest of the REITs. Where Ascott, you only make a 9.8% capital gain if you hold this REIT since IPO to today. But the other 3 of them are all giving you double-digit loss from 22 to 41% since IPO time. Let's look further at their dividends. So this data is extracted from the research report published by Philip Securities. So I just extract it out and present it here. For 2016 to 2019, their dividend trend, all the hospitality REITs, their dividend is more on the downtrend. Far East is coming down, Frasers is coming down, CDL is coming down, Ascott Residence Trust is come down, but it managed to come out a bit before the crisis. It looks like it's a more stable one compared to the rest. And let's look at during the COVID period, all their dividend have dropped by more than 50%, and some even dropped more than that. Let's look at their projected dividend. All the hospitality REITs are projected to recover for 2022 and 2023 in the next 2 years. But we can see that in the next 2 years, they were still not able to grow back to their pre-COVID level of dividend. So the recovery will take some time, and thus there is no urgency to just jump in to slowly get it and worry that you have missed the boat. Let's look at their total returns, which is including the dividend you collected. This is taken from SGX, which is end of March, where we can see that as a month of March, all are giving positive return except ARA. Let's look at their year to date. All the foreign and Singapore property all are giving you double-digit returns. Okay, let's look further 3 years. For 3 years, you will still have 2 REITs that give you negative returns, CDL and Frasers Hospitality. What does this negative return mean? This negative return means that you were to invest in these REITs 3 years ago and you hold it until end of March, including the dividend you collected, you still lose money. Some of people say that long term will make money. That will depend. Why they lose money? Because the COVID have actually affected them very badly. And let's look further 5 years, Fraser will still be negative. And let's look at longer term, we can see that Ascott Resident Trust will have give you a better return of 7.5% return, and which is more than double of CDL Hospitality Trust. Although CDL Hospitality Trust, we look at the price return is about 55%, but if we include the dividend in for Ascott, it actually gives you a higher return of 7.5% annualized total return over the 10 years period. Do take note, this is not a buy and sell recommendation of any of these hospitality trusts. If you plan to invest in one of them, do remember to do your own due diligence. That's all I have to share with you today, and if you feel that you have benefit from this video, do remember to like and share and leave your comment below. Do remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.